Here we're going to discuss the tactical patterns that we use to provide further buy points and further control the risk-reward relationship. If at any point you kind of get a little bit confused and overwhelmed with all of this, I really recommend that you jump to the putting it all together sections if you're overwhelmed, so you can get a good idea of how they all work together. But essentially, if you take a look at this example of C once again, you see that same cup and handle pattern we discussed earlier about how trends unfold. But if you look at all of the small arrows, those are all small tactical patterns which will occur and we'll learn about that give you entries on the right side of that base. Now, when do you use these short-term patterns? Well, you have to know all of the characteristics of a shaper pattern, the right depth, the right length. If it's something past 15%, which is the maximum for a flat base, you know you're dealing with either a cup with handle or a double bottom. And most of these shaper patterns are 7 weeks in length at minimum, so most of these buys will occur on the right side of the base. So most buys, even on a tactical basis, won't occur unless a stock is at least corrected 10 to 15%, and this correction has lasted at least 3 to 4 weeks. With time, and as you become accustomed to shaper patterns, it'll become more obvious to you, but that's a good general rule to have when looking to apply these different tactical patterns. Another great way to think of it is usually there's a pullback at least to the 10-week moving average, and as we rebound off of that, these patterns will show up as well. I mean, if you are wrong, the whole point of using these different tactical patterns is to have a very small risk. So your risk is limited, you can exit, and you can look to re-enter when things are favorable once more. And all of the system has really been designed to allow you to pyramid into your best winners. So by that I mean you keep adding to your stock as it's advancing in price so that you can build a very large concentrated position in one stock. Now, this becomes easier with practice, but once you have all of these tools, it'll be much easier to have all these different buy points show up and to keep adding to your winner. I know most people traditionally look to add to a loser and average down in price, and that's really the recipe for disaster because you're completely breaking all of your risk rules and management. So by adding as the stock is advancing in price, you're always ensuring that the market is agreeing with your original thought, and you have a profit cushion that can help you out if the market starts to move against you. So I mean, but also if shaper patterns are so powerful, why even dive into tactical patterns? Again, it's really to maximize that risk versus reward. When you can lower your risk to such a small level, it's just so much easier to have multiples of that risk to the upside. All of these tools are really designed for immediacy. And that's great because you want to buy a stock and you want to know right away if you're right or wrong. If you're wrong, you want to be stopped out and you want to move your capital to where it can be used more efficiently. And because we buy progressively with tactical patterns, it's much easier to move to cash in a bad market because you're not able to put on more and more buys in a stock because the stock's never advancing in your favor. So you're always naturally underinvested in a bad market. And that will also minimize your drawdown in a choppy market. Another very big benefit of using these tactical patterns is that you'll have multiple opportunities to buy a leader. I mean, one of the biggest mistakes you can make is missing out on a huge advance in a stock price. I'd say the most important mistake is taking too large a loss, but the second one would really be missing out on a 200% move in a stock. Well, unless you have these additional patterns that can help you to enter on a tactical basis, if you get stopped out of that first breakout of a cup with handle and you have no way to get back in, well, that's a very big risk to have in that you can't re-enter with any other patterns. So having multiple patterns, multiple entry techniques is really going to help you be adaptive to a market which is not always so clean or so easy on a breakout. And I'd really say that the importance of these tools has really increased with the advent of algorithms and high-frequency trading. I mean, I think it's relatively easy to program into an algorithm where the prior high is on a stock chart. Everyone's looking there. Everyone knows where the 52-week high is or the last recent high of importance. And so it's just natural for a lot of these algorithms to kind of break a stock out and then drop them 5 or 7% to shake out a lot of short-term investors only for the stock to move higher eventually. And that's why it's really important to have these alternate entry points. I mean, a system wouldn't be very effective if everyone was trying to buy the stock at the exact same time. There's just not enough liquidity at that point. By having multiple entry points, multiple tactical methods, you can really spread out your impact on the market. And so if these tools are so effective, why not just use these tools alone? Why go through all the trouble of having shaper patterns and fundamental analysis? Well, that goes back to the entire big picture and why it's so important to have this overall strategy in mind. You're not going to maximize your potential return unless you know you're dealing with a stock with a huge growth trajectory and you won't know that you're buying a stock ready for a long trend unless you have that shaper pattern shaping that trend. It's really bringing all of these tools together that make it so powerful. You get fundamentals that show you which stocks have the biggest potential, shaper patterns which really show you that the trend is getting ready to launch into a big uptrend and that demand and supply balance is shifting to buyers, and the tactical patterns really bring in the opportunity to have these very low risk entries and multiple ways to enter along that trend that's developing. I created 4 main categories, and it's really important that you know where your tools reside, whether it's these tools or other tools that you want to use. I mean, most people are coming to this course already have different methods for investing. If you know where your tools reside, you'll know when you want to use each tool or maybe which types of tools you're missing. So the 4 categories I would look at is, number 1 would be a coil. So really a dampening of volatility. It's a point in the chart where buyers and sellers again come into equilibrium. And there's multiple ways to use that to your advantage to know when to buy. The breakout is the classic. Most of the shaper patterns reside in this category and you're looking for breakouts above a prior high. The expectation breaker, which is one of my favorites, where when things look at they're at their worst and you're about to break lower and you move higher and instead there's a complete shift, and those are usually the fastest moves to the upside where people are surprised. And the last category I would say is pullbacks, where in every uptrend, it's just normal for stocks to take a break and pull back a little bit. Short term, buyers are overextended and sellers become a little more aggressive. But that pullback is just a great place to add. Not every pullback is buyable. You really want to do it in an objective way, and we'll have tools for you to do that. One last thing I'd like to note is that all of these tactical buys need to be used within 10% of a base or within 10% of a 10-week moving average. As you advance out of your basing structure, the further you get, the more you're at risk for a significant correction. I mean, that's why we use shaper patterns in the first place, is to provide that foundation, that anchor for a sustained up move. So once you get past 10% from one of those basing structures, your upside risk is diminished relative to your downside risk, and it's no longer in your best interest to be looking for tactical buys. Another key aspect is I always try and keep a 5% gain between tactical buys. I mean, sometimes you'll see many of these may occur relatively close to each other, but if you buy too many positions all at once, you have too large of a position, you're very likely to be shaken out by any normal minor fluctuation. So whenever I buy a stock, I wait for a 5% gain before I look for any additional buy points. It avoids overconcentration, it avoids overtrading, and it avoids quick overexposure to the market. Sometimes you put on too many positions too quick and the market has a normal pullback and you're stopped out of everything just before the market keeps moving higher. So allowing for that 5% between buys on a stock allows you to only add over time as the stock is proving itself. So before we move on to our first patterns, let's take a quick look at the moving averages of importance so that you'll know what you're looking at when I refer to them on the stock charts. All the tactical patterns that we're going to be working with are going to be based on the daily chart. So it's very important that you have an understanding of the different averages we're looking at. This can be a template you can use to always refer back to. Essentially, the longer term blue averages is the 200-day moving average. That's also the 40-week average on the weekly charts. The red line is the 50-day moving average. The light blue line here is the 10-week moving average, but depicted on the daily chart. So, I mean, it's very close to the 50-day, but sometimes early in the week on a Monday, the 10-week and the 50-day can have quite a bit of a difference. As you can see, at the end of each week, they end up having the same value, but early on in the week, there's somewhat of a difference that can help you sometimes. The green line is the 21-day exponential moving average. The light pink line is the 8-day exponential moving average, and the very thin line close to price is the 3-day exponential moving average. So all of these different averages will be used in different ways throughout the course. And this is maybe a good chart you can keep on hand so you're always aware of which length of average I'm using and whether it's an exponential or a simple moving average.